Thank you for joining October's investment update. As ever, we've got the chat function or the Q&A function here in Zoom. So as I go through, if there are any questions that come to mind, please type them in the Q&A section and I will go through and answer them all at the end. Time to sell sovereigns. Over the last, few years, I've often had questions about why do we hold government bonds when they're so low yielding, and my response has always been the diversification benefits that we get, the fact that they are a risk-off asset in times of market stress, that they can appreciate when other things are falling, gives the portfolio valuable protection. But I'm going to go through some of the work that we've been doing recently and explore that a little bit further. And I think it's probably time that we reduce our sovereign debt exposure, which is what we intend to do. So that's the title, that's the main topic. But I'll start first of all by just touching on equity markets and bond markets and where we are. We've seen that strong recovery in equity markets, specifically in large cap stocks, and I guess in the US. The dark line here, global equities, has rebounded all the way back to new highs, something that I am a little bit surprised about. I didn't expect that to happen as our base case, but as with all things in markets can do what they want to do, and the amount of stimulus that we've had, the amount of support that we've had from governments has definitely helped that. But it's really a two-tier market. I think the UK market that you see here is probably a little bit more reflective of smaller caps and a more broad-based market. So a lot of the comments that we make in the analysis that we're doing here is really about cap-weighted indices. And of course, the largest companies are dominating that more than they have done in the past. So when we say equity markets are expensive, it's very much driven by the top 10 stocks by market cap. And it's not to say that there aren't opportunities elsewhere. There are definitely pockets of value. And as we emerge from lockdowns and we start to get back to normal, we start to get more treatments that work against the coronavirus, we start to get more recoveries, we start to get fewer deaths associated with the cases that we have. Hopefully we can get back to some level of normality. Then there's definitely a lot of investment potential in these beaten down sectors, many of which haven't really recovered very strongly yet. So the headline top level, I think, can mislead you from what's happening beneath the surface. Looking at fixed income, we can see that the dark line there, government bonds, which is going to be the topic of a lot of what we talk about here, provided that insurance policy that you look for. So they have risen in value as markets had a wobble and fell. Yes, equity markets have recovered, but that government bond insurance policy is really paid out, and you can see that they're holding up there. So last couple of years, strong returns from government bonds. On credit, corporate bonds and high yield bonds, you can see the sell-off that they had there, that recovery. It's the recovery in financial markets did stall a little bit in Q3. So it was very strong in Q2, and as you might expect, a lot of the easy money, if you want to call it that, was made in Q2 and in Q3. As valuations became a little bit more stressed, you've seen some of that recovery peter out, especially in September. Okay, just starting with equities. This is the main exercise we go through, looking at valuations and considering different scenarios of what might happen over the next 3 years. So our long-term strategic asset allocation is based on a 15-year time horizon, but when we start looking tactically, we narrow that down to a 3-year time period. And we think about if we were to buy equities today, hold them for 3 years, collect those dividends, what kind of earnings growth might we have? What kind of valuation might we be able to sell at in 3 years' time to give a return number? And the base case that we focus on, and that is plotted in the charts below, is the annualized return for 3 years, selling out at a PE of 16. Now, is 16 the right number? Historically, that's been where things have oscillated at. but there are times when it's been higher and there are times when it's been lower. And if we think about a market that delivers earnings growth and starts to recover, it's very conceivable that that multiple might be maintained on the higher side. So if we continue the recovery and we revert to trend earnings and we sell out at an 18 times multiple, then maybe we'll get 5% a year from equities from the next few years. And thereafter we could move on to a more normal earnings return. But it's not the only outcome. Equally, recognizing that markets are a little bit expensive and financial markets are probably ahead of the economic recovery that we've got, anticipating that recovery. We might have wobbles, we might have a pullback. It's possible that there might be a correction and then a recovery. But the general outlook over the next 3 years for equities is one of lower returns compared to the average return you would get from equities from here. Just a quick reminder, when I talk about that normalized earnings and that recovery, this is that line of the cyclicality of earnings per share for global developed equities. So you can see it has peaks and troughs. The dashed line is the line of best fit that we've put through there, just representing a more normalized view of earnings. And the crosses represent consensus expectations of that recovery. The diamond or the triangles are what I put on as we started to enter this recession that we've had, and pretty much the experience is tracking towards that. So we should see things start to improve in the second half from the earnings side of it, and hopefully into next year. But there's still a lot of work for the economy to do in order to deliver that. And we shouldn't underestimate that it's going to take time. I think that's what we have to understand. And as that time takes place, we need to be a little bit patient as investors here. Looking at the bond market, so at the bottom, the light blue line is UK government debt, so 10-year debt. Lend in the government money for 10 years, they pay you a level of interest, and at the end of that 10 years, you get your cash back. The yield to maturity, so the annualized return that you would get if held to maturity, is pretty much close to zero. So the expected return for government debt, a fraction of a percent, so 0.3% at the moment, but pretty close to zero. As soon as you start to take on some credit risk, if you're in the most secure corporate credit that's around, that upper end of investment grade, you can get another 1.5%. If you move into the lower end of investment grade, you can get just over 2%. And if you venture into the high yield market, you can lock in just shy of 6%, provided that those companies pay you back at the end of the bond and they're able to meet their coupon payments. Now, we know that there's a lot of distressed companies out there at the moment that have taken some severe hits to their balance sheet because of loss of revenue from shutting the economy down, so that we know that defaults are going to be higher. So for sure, when you enter this area, you've got to be a lot more selective. But the reality is, if you can find high yield bonds that are going to pay you out to maturity, and you can hold through that, then a 5% return is attractive, given the comments that I've just said about equities, where those equity returns are likely to be in the same ballpark. And of course, with high yield debt, you do have slightly more protections. You're higher up the capital spectrum than equity. In many cases, there's the option for equity investors to put money back into a company in order to shore up the balance sheet and help out. So being higher up the capital spectrum does provide you some protection, but still you need to be very careful about the companies that you're investing in there. Okay, just on the economy quickly, we have seen purchasing manager indices improve. So we've seen the manufacturing side of the economy start to pick up. We start to see inventory levels be restocked, and we start to see factories coming back on stream. So that's a good thing, and that's part of the path to recovery that we've been on. Looking at the services side, it's recovered as well. It's a little bit more patchy. So there's areas where there are still lockdowns in place. There are still restrictions about how long you could be out, for example, and what businesses are open. And it's harder for some of these businesses to serve the number of clients that they used to do because of social distancing rules. So that service recovery is a little bit slower. And it's worth understanding that this is very different from normal recessions. Normally, it's the manufacturing side that is the swing factor that swings down and then up. The services side tends to be a lot more steady. And here we've seen that be far more impacted compared to the manufacturing side. So it's a little bit different to normal there. But anyway, a lot of work to be done. Okay, let's get into the meat of what we want to talk about here. So government bonds. Here we've got, to start with, just a bit of perspective, the national debt for the UK and for the US. You know, they're in trillions. Obviously, the US is an order of magnitude greater, about $27 trillion of debt outstanding in the US. In the UK, just above £2 trillion worth of debt. And roughly, if you divide that by the head count, I think in the US, you get about $80,000 per person, not per working person, per person. And in the UK, instead of $80,000, you've got about £20,000, I think. So I guess one way to look at this is there's plenty of scope to rack up more debt in the UK if we want to aspire to reach the levels of profligacy that the US has reached. I don't think that should be seen as a target, though. Perhaps the takeaway is that there's a lot of debt out there, and clearly that has to be held by someone. And at the moment, we are invested in some of this debt. This is the same exercise that we do with equities, that 3-year time horizon. If we buy now, hold for 3 years, what kind of return? And thinking about some of the scenarios. And for fixed income and government debt in particular, this is particularly worth doing at the moment. As you can see in the center there, the current yield on the 10-year bond is 29 basis points, or 0.29%. And that means that if you buy it, hold it for 3 years, and then yields are unchanged, so the situation is the same in 3 years' time as it is now, but just those 3 years have moved forward. You've had 3 years worth of interest payments, and you're 3 years closer to maturity. The return you get is 0.31%, so pretty similar under the no change scenario. Now, that's a low number. It does not compensate for inflation. It doesn't let you participate in the economic growth that should be happening. And frankly, it's as close to zero. We might as well call it zero. But that's not the only scenario. There's an upside scenario and a downside scenario. Let's talk about the risks first. Historically, the 10-year bond yield has been pretty closely linked to nominal growth rates. So if you've got inflation of 2% and you've got real growth of, say, 1.5%, or let's just say 1%, let's say growth is going to be lower, you would get a number of 3% there for nominal GDP growth. And that would mean that the 10-year bond yield should gravitate towards that 3% level. Now, you notice 3% is to the right-hand side of the table here, and it's actually slightly off the chart. If bonds were to normalize to that level and things were to get back to any kind of normal situation, then we would be looking at a couple of percent loss per year as those yields rose and the price fell. So we would have a capital loss during that period. And 3% a year quickly stacks up to a 9% loss over a 3-year period. There is potentially the risk that could go even higher. So if bond yields were moving higher, possibly that would be driven by inflation, which maybe was more than 2%. Maybe inflation was 4%, in which case you could find that the bond yield might go to 5%. And you'd have bigger losses. So there's the risk on the downside is that things improve, the economy gets back to some sort of normal shape, and then as a holder of these gilts, you could be nursing some losses. So you expect zero return. There's a risk of some big losses. But what about the upside? Now, the upside really comes from yields moving into negative territory. And the reason they might do that is because the Bank of England cuts interest rates to negative rates, as they've done in some European countries. Now, if we look at the places where they've cut rates, no one's gone below -1%. And it's been very difficult for those countries that are in negative rates. Their banking system starts to come under stress. Things just don't work as well in a negative interest rate environment. So it's our view that for these bond yields are going to struggle to really go much further into negative territory, and to go below -1, I think is just an unrealistic expectation. So that starts to put a cap on your upside. You could think of, maybe 6.6% upside is the best case scenario if they were to move to that -1 level. So not much expected return, risk of losses if any kind of normalization happens, and actually a capped upside of maybe 6% return. And bear in mind that government bonds have done very well this year. They've given you about 9% return, I think, year to date. But you're unlikely to get that going forward. I think 6% is probably the best case scenario for government bonds from here. For the 10-year, I guess, not for, if you have a longer duration bond, it could be a little bit more. But the reason we've held on to government bonds for so long is because of the diversification benefits that we get. And I've been through this before, but it's worth just reiterating. This is total return for various different bonds in their local currency. So Swiss bonds, it's the return in Swiss francs for holding that Swiss bond. And then you can also see the MSCI World in that faint grey line there. So as the crisis unfolded, equities fell 20–30%. You could see initially all of these bonds reacted in a positive way. They started to appreciate in price, but not by much. Okay, the best that you got from Danish bonds, and I think it's German bonds there, was you had a 5% profit at one point there. But then, of course, you can see that faded away quite quickly, even as the crisis got worse. So it got to the point where those negative yielding Danish and German bonds, you'd had that knee-jerk reaction of a flight to perceived safety, and you had an appreciation in those bonds. But then people looked at them and said, well, how much negative, how further into negative territory can these go? Why am I holding something that, if held to maturity, is guaranteed to take a loss? And you can see those bonds actually then sold off even as the crisis got worse. And if you look towards the bottom of the equity markets there, you can see Swiss investors who had Swiss bonds thinking that they would provide a hedge. They had a loss on those. Danish bonds you had a loss on, Japanese bonds you had a loss on, and German bonds were mildly positive, about 1% positive. So holding government bonds and looking for diversification, looking for them to appreciate in times of market stress, they really failed this time around, where they started off with 0 to negative yields. And of course, that's pretty much where we are in the UK now. So I think the expectation should be that historical correlations, which were for negatively correlated bonds to equities, when yields are positive at the 0 bound and below 0, it's not clear that they're still negatively correlated. In fact, at that point, those diversification benefits come under question. But what can we do? So we don't have high expectations of returns. We've lost diversification. They're still liquid, so they're still we can sell them if we need to get cash. But those other two props have really been taken away from government bonds. One of the things that we can do is we could think about, well, what if we sold our government bonds and we replaced them with a very short-term corporate credit constructed in a bond ladder? So if we own a series of bonds which expire every 3 months. So I've selected 5 bonds here. You can see the different yields that were available in the market when I selected them, and just gone through the exercise. What if we owned these instead of the government bonds that we own there? So you can see they expire in November 2021. So that means that that company would pay you back the whole of the principal plus the interest that they owe you. You would get that money. You would lock in that known positive return of 1.04% for the cooperative bank bond here, and you get your money back. And then in January, you get your money back from the Daimler bond. And then in April, Deutsche Telekom would repay you. And in June, Scania would repay you. So you'd have this ladder which is constantly rolling towards you, and you're getting your money back. So it's quite low risk because you get your money back in a short period of time. Allows you to reinvest in any opportunities that might be around at that time. You are getting a positive return. So the yield you can get here is above 1%, so 1.12. It's not big, but it's better than the 0 that you're going to get with the government bond. Currently, the government bond we have is the 2034. It's got about 6 years duration, which means for every percentage point change in the yield, you get a 6% return, positive or negative. But currently, if retail price inflation is 2.9%, the return that you'll get from that if held to maturity is 12 basis points, so 0.12%. So you can pick up about a percentage point of return, and there's very little, not very little risk, but there's a high degree of certainty around that return because you intend to hold them to maturity. Whereas with the government bond, obviously there's uncertainty, depends on what yields are in a couple of years down the line. So we can reduce interest rate risk and we can increase return. Now, before embarking on any kind of radical change, we need to do all of the research and analysis that we can. And one of the things we really need to get a handle on is well, what if we're giving up diversification? And remember, we're not necessarily giving up diversification because it's being taken away from us anyway. The theory here is that government bonds won't protect us in the way they have done in the past. So can we do something different? We can look at what would our portfolio risk be like with the government bonds or without the government bonds, and instead holding that ladder portfolio. We use Axioma, which is our risk tool. It's one of a number of ways which we can look at risk and potential drawdown, potential volatility. And it analyzes the holdings that we have, compares how they all interact with each other to come up with its predicted volatility of the different portfolios. And actually, surprisingly, you can see that the ladder portfolio here that I just showed, those 5 bonds on the previous slide, they actually reduce the predicted volatility. So the takeaway from this is not necessarily that we can reduce risk by selling government bonds, but the takeaway is that we can sell our government bonds and invest in conservative, short-dated assets without materially changing the risk of the portfolio. So this is something that we can do, and we can still stay within the risk profile. We can still manage that potential drawdown and volatility and make sure that our risk rates are providing the solution that we expect and that everybody has signed up for. Just digging in a little bit deeper to explain how this works mechanically. I've picked the defensive portfolio here. So the defensive sits in our risk grade 3. It holds roughly 30% of equities at any one time. I mean, it can hold more or less depending on the opportunity set that it sees, with roughly the rump 70% sitting in bonds of some sort. So it's got a lot of bonds in it, so it's a good portfolio to use to understand what the change might be for selling the government bonds and replacing them with this ladder portfolio. You can decompose the risk, the volatility, into where it's coming from, which assets are contributing to that. As you would expect, even though it's a small part of the portfolio, the 30% in equities, that's still the main driver of your volatility and your risk. So of the 10 percentage points, 10.7 percentage points of risk there, of volatility, 6.73 comes from the equity, and then 3.95 comes from the fixed income side. And then you can dig further into the fixed income and see what about fixed income makes that volatility and produces that risk. And you can see in the blue charts on the right hand side at the top, a lot of it is from our investment in higher yielding bonds. So 2 percentage points of the 3.9 come from high yielding bonds. Some of it comes from our investment grade bonds. Some of it comes from our industry risk. We have some financial bonds in there, for example. A tiny bit is from those issuer specific risks, so the particular companies that we've chosen to lend to. But the bulk of the risk really comes from where in the capital structure you are. Are you high yield? Are you investment grade? What protections does a bond provide? But on the left side, you'll see interest rate risk, that 0.56. And also that 0.35 inflation break-evens. So those two are really the contribution of risk that's coming from our holdings of government bonds. It's the sensitivity to interest rates, how might yields change, and also the sensitivity to market expectations of what inflation will be. So they're the two things there. So what happens when we compare the two portfolios? So the left-hand side is with government bonds, The right-hand side has got the corporate bond ladder. So we can see that that interest rate risk comes down. That inflation break-even comes down as well because we have the inflation-linked bonds in there. And instead, we have slightly higher high-yield spreads and slightly higher investment-grade spreads. So we're swapping out interest rate risk for credit risk, but in a controlled way that is investing in short-dated credit that liquidates itself and pays us back pretty quickly. So there is a loss of diversification. As I said, government bonds at the moment, they still have that negative correlation, and the risk model expects them to keep that. The equity portion of both of these portfolios is exactly the same. It's the same holdings, but you can see the risk from the left-hand side where we have government bonds, it's only 6.11% coming from the equity market. But where we don't have the government bonds, we've got the corporate ladder, it's just slightly higher, 6.34. So the aim here is not to say that these numbers are, they look precise because they're to 2 decimal places. The aim is not to say that these numbers are going to be perfectly predictive of what happens in the future. It's just one of the tools that lets us understand what's the expected impact of such a change. How might the portfolio behave differently if we were to enact this? And it's part of the research that we would do before making any substantial change to how we're invested. So in conclusion here, we can get a portfolio that remains in line with a risk portfolio by substituting government bonds for short-dated corporate debt. It lowers our exposure to interest rate risk. So in the event that interest rates rise, and they might rise due to really 2 things. They might rise because the economy strengthens. That would be the best way. We get strong economic growth. We get faster GDP growth that's not inflationary. We produce more goods and services that come into the economy. We get out, we enjoy our lives. And we can cope with higher interest rates because the economy is strong enough to cope with them. Or it might rise because inflation starts to become a problem. We're not necessarily producing more goods and services, but we're having to pay up for them because there's so much money in the system chasing a fewer amount of goods to buy. Both of those reasons might put pressure to increase interest rates and hence for bond yields. So we can lower our exposure to either of those risks. And we can also get slightly higher return potential. So there's about, I said, a 1% pickup in return from that part of the portfolio. I mean, it doesn't sound much, but in a low return environment, as we discussed at the start, with limited expectation for return in the short term from equities and from credit generally, having an extra percentage point is definitely going to help and hopefully help us compound through time. And I think one of the things we should be aware is, we are in an area where we're going to have to accept a little bit more volatility in order to generate return. All of the risk-free assets, all of the safe ways to invest, the safe ways to save, that aren't very volatile in the short term, have really been taken away and squeezed. In order to ensure you're going to get adequate returns from here, you have to lengthen that time horizon. And of course, as soon as we start to do that, we discover that that these high yielding assets are going to pay off, because if held to maturity, that corporate bond ladder, for example, is going to pay out that 1%. If held to maturity, we will get the loss from those government bonds. So it's about having the right time frame and understanding that 5 years down the road we'll be better off in certain assets, and those people who are hiding in what they think are low risk assets we'll find that they're disappointed by the returns they get there. One of the drawbacks is we do get slightly less inflation protection, but it's pretty easy to compensate in the portfolio elsewhere for that. So that's not too much of a concern. Okay, so having covered that, and we go into Q3, talk about some of the things that we've done in Q3 and how performance has been generated. Here's the current portfolio. This is the balanced portfolio I see that we've got here. For the other risk grades, the names that we hold, the individual line items the same, but the weights will change to get the risk in the right direction. As you can see, a good spread of different equities across the geographies. I guess should point out we bought our first Japanese company recently, Kao Corporation. We haven't held historically a Japanese company because we haven't found any that have been attractive, but for reasons that I'll go into it in a little bit, this is a really nice addition to the portfolio. As a refresher, our approach to investment is one that doesn't constrain itself by regions or sectors. So we never feel compelled to own a certain sector. We don't feel compelled to own banks or mining companies, for example. We don't feel compelled to invest in Europe or Japan. The reason we do so is because we can find companies that we think are attractive, and everything has to earn its way into the portfolio. So here's the trades, the significant changes that we've made over the quarter. I'll just go through them, starting with July at the bottom there. So in July, we took the first step to diversify sovereigns. We reduced the amount that we have in government bonds, reflecting the fact that we took the view that our insurance policy had paid out, and it was the sensible thing was to take a look at the longer term prospects and think about what assets would do well, over the next 3-5 years, and how that capital might be better used. So we added very much to our infrastructure holdings in Brookfield and Athiona, two companies that have globally diversified holdings of highways, hospitals, ports, that essential infrastructure, that the fabric of our economy that lets us do what we need to do. And we also added a little bit to gold in order to get some of the diversification still. So we realized that by selling down our government debt, we wanted to still have some assets that could appreciate in a risk-off environment. So we added a little bit to gold. In July, we had a new investment idea from our UK team. Thank you very much, Andrew Evans, who's done a lot of work on Rightmove. So we took advantage that was still quite a depressed stock with concern over the UK housing market, and we established a position there. And we sold some of our high-flying tech names that have done really well, Microsoft and Oracle. Still positions in the portfolio, but just trimmed some of the weight there. And then also trimmed Howden and Taylor Wimpey, just to control that housing exposure and make sure it was not too big and not too small. In July, we started to do work on that US dollar, the threat that the US dollar might depreciate specifically against the euro. And we started to buy Danone, a European company that has exposure to Europe and emerging markets. So trying to get our companies to earn their cash, not just from US dollar, diversify away from US dollar earnings and into European earnings and Japanese earnings. Countries where they have current account surpluses, where there's strong productive capacity, and where those currencies might appreciate. And we sold Fresenius to fund for that, which, despite being a European company, has significant exposure to US earnings. August, we bought a healthcare company, Intrim Technology again. And then recently in September, we made a couple of changes here. So I'll start with what we purchased. So we purchased Alibaba. Alibaba is mainly a Chinese company, so it's listed in the US, but it's a Chinese company. I mean, it's deeply embedded in the Chinese economy. It's a key way that companies buy and sell to each other and interact. It's very much a Chinese revenue stream, so it falls into that camp of diversifying away from US dollar earnings, giving us some exposure to Chinese earnings. And of course, China has a trade surplus. It's a very productive country. From that point of view, has a lot of wealth there and should be able to grow its consumer economy as well. And we also bought Kao, which is a Japanese. It's a Japanese cosmetics company. They started off their business selling soap. It's pretty unique in Japan in that it's grown its dividend every year for 30 years. So strong dedication to growing that dividend. It's very ESG friendly in the way that it's trying to minimize its use of plastics and really put that at the heart of its product design. And it's a well-run company with good returns on equity, good returns on capital, that has very much sells to Japan. So it gives us a Japanese yen earning stream there. Again, the yen traditionally is a strong currency that has very productive capacity. What did we sell? So we sold ExxonMobil and General Dynamics. I put enhanced ESG as the reason there, but again, that oversimplifies things quite a bit. So General Dynamics is a weapons company. We've recently done a lot of thinking about our approach to ESG, and I guess the simplest way to explain the things that we've put in place is twofold. On the social side, we think that we want to own the best companies in the world, and the best companies in the world to us are ones that have value because they solve people's problems, they provide goods and services that people want and are willing to pay for. In essence, they're enriching people's lives and making their lives better. So General Dynamics, as a weapons maker, doesn't fall into that category. Selling weapons doesn't make people's lives better. It's actually quite negative for a large amount of people. So on that basis, we didn't want to hold it. It also, because it's a US dollar earning stream, it also falls into that desire to diversify away from US dollars. So I had a double tick in the negative box there. ExxonMobil, we also sold. On our environmental side that we consider, we think that the best companies in the world should be companies that clean up after themselves. So if you're having an impact on the environment, the key thing is, how do you mitigate that? How do you make sure that you're not leaving a mess behind you and you're actually cleaning up after yourself? Now, in this day and age, we live in, news travels so fast over social media, and there's no scope anymore for companies to have a bad reputation. If the consumer is all powerful, if it decides to stop buying, then you can quickly get boycotts. So we sold ExxonMobil, and we have plenty of exposure to renewable energy. One of the things about the oil market at the moment is there's a lot of uncertainty. We've seen significant growth in power generation from renewable sources. Of course, this is one of the key problems of our time. How do we generate clean, renewable power to sustain our economic lifestyles? And really, we're at a tipping point. So we've seen the oil price come down because there's been a reduction in demand because we've all been on lockdown. But at the same time, we've still seen that productive capacity from renewable energies really kicking in. And of course, the question is, well, as we recover, will the oil price recover and will demand for oil recover? Or will the growth in renewable energies kind of outstrip that and keep the oil price suppressed? So whilst one of the factors to sell Exxon is the fact that it's not really cleaning up after itself, it's focusing on legacy technologies, probably the bigger part is the growth is under question. And what will the oil price be going forward? Will they be able to grow their business? Will they be able to get good returns? And I think that is unclear to the point that it no longer earns its way into our portfolio. So, as with all things, it's a balance of many factors. On ESG, we consider, are you cleaning up after yourself? And are you providing a product which is useful to society? Hand in hand with, are you a profitable company? Have you got a strong balance sheet? Are you got a competitive advantage that can fend off the competition and maintain your return on investment for a long period of time? And we want to make sure that we're holding the best companies in the world, and that every company's earned its place. And Alibaba and Kao earn their place. Unfortunately, Exxon and General Dynamics do not at the moment. Going to performance, so looking at the third quarter, as you saw, equity markets sort of stalled off in the third quarter. The US market was still fairly strong, so our US equity holdings were up 1.2% for the quarter. The UK was up 0.3%. Quite a strong move from our emerging market holdings. Tencent and Alibaba will contribute there, but a bit of weakness from European holdings. Our infrastructure holdings performing very well, up 5.6%. But overall, the equity building block, a small positive return there. The standout was really fixed income. So our investment grade bonds and our high yielding bonds giving really good returns there, 3.2 and 2.5. So actually the fixed income part of the portfolio doing the heavy lifting. And that's why you'll see some of our lower risk funds have actually done better than some of our higher risk funds in recent times. So that's because the fixed income component's done very well, and the equities have just paused a little bit there. Digging down into some of the winners and losers for the quarter. In the US, Facebook, a standout performer there, and also Cognizant. So Facebook up 10%, and Cognizant up 17%. So good results there. Some of the healthcare, Medtronic doing well. Exxon a bit of a detractor as the oil price remains weak. So the ones in red have been sold, the ones in blue, new additions in the quarter. In the UK, we saw Intercontinental Hotels really helping out and contributing there. So stock that we see a lot of value. Again, as I said at the start, it's been a two-step market. Those companies which are sort of doing well independently of COVID, you can think of that as the technology companies or that core infrastructure that the world needs regardless of how it's operating. They're very much driven by stimulus. You see them moving up and down as the stimulus talks in the US are going on at the moment. But then the other side is those that have really been impacted by COVID and our change of economic patterns. You know, how quickly will we get back to some sort of normal behaviour? Yeah, we have a mix of both in the portfolio, designed to do well there. Looking at infrastructure on the right hand side, you can see some really strong returns from Brookfield Infrastructure there, 10%. So as I said at the start, that owns ports all around the world, highways, hospitals, etc. Some exposure to emerging markets there, really well run company. It's a US listed, but it's very much a global earner. And Ørsted very strong. So Ørsted's the Danish wind company that installs wind turbines and operates them. So offshore wind power, which has become a very compelling way to generate electricity, up 14%. And in the news a lot recently with a couple of positive developments for that stock. Not least Boris's statement the other day that wind is going to be, we're going to lead the way in wind. On the bond side, you can see some just generally strong returns across the board there. So a lot of 2% returns. Stand out as the M&G bond, 9% return there. That was bought pretty early on in the quarter. There was still a lot of good value bonds to be had. I think it was probably 4.5% yield when we bought it. That yield's compressed now to 4%, and we've seen some of that return be pulled forward. So 9% strong return from that bond, but good contribution all round. In the high yield section, Barclays and Lloyds, they're CoCo bonds, so conditionally convertible bonds in the event that banks get stressed. So they're definitely higher risk bonds that we have in the portfolio, but they did strong returns. Again, we added to those as the crisis was unfolding. So some good returns from there. And then a small positive return from our gold holding, up 1.6%. Government bonds pretty flat, so 0.18% there from government bonds. So all in all, an okay quarter. So that's the presentation. I'll take questions and answers now if we've got any through. Let's see if I can. Oh. Stop sharing. See if we can. Here we go. Okay. Only two questions. A couple more. First question. Haven't negative interest rates proved fairly useless thus far in creating inflation? Yes, I would agree with that. Negative interest rates, in my view, have been a problem for the banking system, and where they've been enacted in Europe and well, mostly in Europe actually, where they've been enacted in Europe, the banking system there has really struggled to make any progress. It's struggled to make profitable loans. And if you look at the equity performance of the banks, especially the systemically important financial institutions, which get a special name, they've just bled down pretty persistently there as they've struggled under that environment. So I don't think it helps the economy, and I think anyone who's looking at that really would say, why would we want to do it? Having said that, the Bank of England is talking about doing it, so it's a possibility. Next question. When talking to clients who are investing today or over the next 3 to 5 years, what would you say are the expected total returns for risk grade 4 and 5? That's a very specific question there. I'd have to go and probably crunch the numbers properly to do that. But I think the way to approach it is, you know, equities generally should be priced to give you about 7 to 8% return. But where we are today, we've got a lot to work through. We've got valuations that expect us to work through that in a favourable way, and that just means that 8% is going to come down, maybe to, let's say, 4%. I mean, we're talking over a 3 to 5 year time period. There's a huge amount of uncertainty. So the range around that 4%, could be 10, could be minus 20. It's just huge variability around that. But I would say, temper those expectations from maybe 8 down to 4, and then for the fixed income side of it, as I said, there are things that we can do to continue to get that part of the portfolio to work very well. There are also opportunities in high yield where you might get returns potentially similar to equities. So, maybe 2 or 3% there. But it's in the short term, it's definitely lower return expectations. Okay, Mark Williams, with the US third quarter results season about to start, do you think the outlook statements will provide a reality check and down revisions to earnings outlook? Was that already discounted in the market? So we've seen the pattern that we've seen is a huge amount of uncertainty in the first quarter, as nobody knew how it would affect different companies. As we moved through into the second quarter, we started to see a lot more corporate communication, which helped investors really understand what kind of impact it would have on companies. As we move through into the third quarter, I think people have started to get their head round, who can survive under different scenarios of how long might it take us to recover. And things have picked up. So we've seen economic activity pick up and restart. That's taken the stress off things. That's started to give positive revisions. I think that the next step, it's not going to be a one-way street. They're going to be starts and stops. We're already seeing a slight step back with some of the local lockdowns. So I think Q3 it's possible that we might get some disappointments out there. Whether the market's already looked through those, I think for some companies it may have looked through those. For other companies, it maybe not. It depends sort of where the share prices are and what's been communicated. But I think there'll be some positive surprises and some negative surprises. But it will definitely be a mixed quarter, I think. To what degree would our investment strategy change if the Bank of England were to introduce negative rates of interest? Yeah. So I mean, what I've been talking about today is the fact that government bond yields are so low, and one of the reasons that they're so low is because interest rates are pegged not just at zero, but are expected to be pegged at zero for a long period of time, and that has, if you think of it as a string, has pulled down the yield curve towards zero. And if they were to go negative, it would pull it down even more. Yield curve is currently, I think, is negative out to about 7 years. So you have to start investing 10 years or 15 years to get a positive yield to maturity. So we're already in a tricky situation. And I think this is one of the biggest investment problems of our time. Anyone who's trying to construct portfolios that aren't just equities, that are multi-asset portfolios that have some sort of risk control in, this asset class has really been taken away from them, and they're having to think about how they do things and try and do things a little bit different. And as you can see from the work we've done, we're trying our hardest to compensate from this, but it is a difficult challenge. I mean, simplistically, if there are negative interest rates, we don't believe that a negative yielding bond is an investment. It is purely at that point a speculative instrument or a hedge instrument, and you're paying for some sort of perceived protection that may not come around. So I think the simple answer would be we would have far fewer, if zero, government bonds in the portfolio. The next question: what is your view in respect to UK index-linked bonds? Are they a position worth holding? My view is that if you're going to hold government bonds, then index-linked bonds are more attractive long-term investment than the conventional bonds. that is because of the risk down the line that inflation rises. Having said that, the real rate of return that you expect is still pretty small. So they will give you a payoff in the event that inflation rises, but it's not a panacea. It doesn't solve everything. So I do think if you're going to hold them, I think index-linked bonds are the things to hold for long-term investors. But even there's questions over whether they're worth having in the portfolio. Okay, next one. Where do I think tech is heading in the next few months, especially with upcoming presidential elections? I think that the presidential election it's a key thing, but I guess at the same time, okay, so you've got maybe Trump wins, maybe Biden wins. If Trump wins, there could be a period of time where it's contested, I guess, in either case. So you've got three scenarios. Trump wins, Biden wins, somebody wins, but nobody accepts defeat. So you kind of argue about it for a period of time, and there's some uncertainty there. And I think that's the scenario that people are looking at when they're buying options, and then when you're seeing that volatility in the futures market around the October and the November elections. I think that's kind of playing out recently. When Trump was running against Hillary, the market, all the discussion was about how Hillary was the better candidate for the market. She was the more market-friendly person, and Trump was the wild card, and he would not be market friendly. All of that is true, I guess, and we've learned to live with the wild card nature. I think we all turn the TV on and get a little bit of entertainment from some of the crazy things that get spoken. But if you looked at policies that Trump had, he was going to cut corporation taxes, and he was going to spend money into the economy in a way that was friendly towards businesses and remove red tape. And actually, he has done quite a lot of that. So if you look at how the stock market performed after Trump got in, it just went straight up. Now, Biden is suggesting that he's going to reverse that, and not just reverse it, but go another step and go the extra mile there. So he's going to raise corporation tax on companies. He's also going to raise taxes on the people that hold those companies, so on US investors that receive dividends and capital gains from equity portfolios. And those things, I mean, the rational expectation would be the benefit you got from Trump and then his change in the tax code, you should unwind that and more. So I think Biden is quite a negative candidate for US companies with US earnings. Again, it's one more reason to diversify away from US earnings streams that are dependent on US companies and US dollar. Now the tech companies in particular, to get to your question here, they tend to be a lot more geographically diversified. So some of their earnings come from the US, but actually a lot of them come from overseas as well. They're very much global companies, and half of their profits are from the US, and roughly half are from overseas. A lot of it rooted through Ireland. They've got a lot more tricks up their sleeve to, I guess, cope with changes in the taxation system. They're a lot better resourced in order to figure out what they need to do in order to keep some of their profits, basically. So I think that they will be a bit more protected from that side. But the other side is they're getting brought through the ringer in the political process and very much used as a political football. So each side wants tech to work for them. and they're very much at risk of having regulation move against them. And I think they need to step very carefully to make sure they don't help any one particular candidate. And I think they've probably been doing that to make sure that they're not a part of. They don't want to be accused of influence in this election, because then they're at risk of more regulation. Now, all of the regulation that has come in, as generally is the case, regulation benefits the big companies, because big companies are better placed to cope with it, they're better placed to deal with it, and actually it forms a barrier to entry and it gives them competitive advantage. So regulation as such is not necessarily bad for the big tech companies. It will just prevent them from having competition. I think they're already too big to make substantial acquisitions at this point if they were to try and, or other than if they're told to buy Chinese companies like TikTok. But if they were trying to consolidate domestically, I think there'd be quite a lot of resistance to that. And I think that'll be quite difficult for them to do. But in general, the regulation would probably help them. They should be less acquisitive. But there's huge competition between tech companies. I mean, Microsoft and Facebook, Microsoft and Google, for example, that competition for that cloud revenue is pretty intense. Google and Facebook compete in the advertising market. So I think it is a very competitive market. They compete with each other. There's just a handful of players there. That's probably enough on that question. Brilliant. Well, that's all the questions we've had. Hopefully this is useful. You've got an understanding of the type of work and analysis that we do and the decisions and why we've made the decisions we've made. And I think we're well positioned here for the fourth quarter. It's a tough environment, but I think that everything that we've got in our portfolio has earned its way in there and is set to do well. One more question here. With the suggested changes to fixed income, what do you see would be the effect of slow growth but higher inflation? Do these two opposing forces mean no change to rates? And do you think that's a likely scenario? I think it's very difficult for rates to get up, to be moved up. It's slow growth but higher inflation is really the nightmare scenario for central banks, and we're talking about stagflation at this point. So the question would be, well, will the Fed be forced to raise interest rates? And I think they will use every tool in their toolbox to resist that. So in the short term, it's only what probably happen is equities would sell off initially as inflation moved higher on the expectation that the central bank would cut rates, or would raise rates rather. But then when that didn't happen, equities would be seen as the beneficiary of loose monetary policy in an inflationary environment, and they would sort of things would just become very volatile. It is probably the main takeaway in that scenario. And navigating through with a cool head becomes probably the most important thing that you have to do. Okay, well, thanks for joining. Hope this was useful, and I'll see you next month. Bye.